We have to put it into perspective as to where we were last year, that the FANGs are still trading off 15% from their highs last year. So there is room to run. We're also looking at free cash flow. So when you look at their ability to generate cash, they may not be paying it out in dividends, but they are buying back shares. They are doing CapEx, and that will give continued support as well.
We're right, Kristen, at a level that seems to be key resistance. We've gotten over this 2,800. Now it's 2,815. That level of resistance from the fall. How critical is it to get over that level? And then if you do and you can close over that, then what does it mean for where we go from here?
So I think the major question that we're getting from investors is, have we gone too far or too fast?
Sure.
And so
legit question.
Too fast, true, right? So too fast, thinking that we're going to annualize 60% returns is unrealistic. Too far, I think that's the question. That trade is probably the biggest risk right now. But when you look at what has really fueled this rally has been fueled by initially short coverings, then share buybacks. And so what we're looking at is, once we get to that 2015 level, do the actual outright longs come into the market, and then that will give this market legs, where we could then see 2,900, 3,000 on the S&P 500.
I'm glad you raised the issue of too far, too fast. Mike Wilson, Morgan Stanley, right there yesterday, worries about that and says there's no justification for the reason that stocks have come this far, this fast. He's worried about profit margins. He thinks the correction is going to continue. Let's listen to Wilson yesterday. We'll talk about it on the other side.
Some of the overhang from last year that we were worried about in earnings are still there, and some of the evidence now is coming through. For example, we do think the economy overheated last year, right? The fiscal stimulus, arguably the timing was poor. Okay, it happened at the end of a cycle, caused the economy to overheat. That led to cost increases and then margin pressure. That was our call for the earnings recession this year. And we just don't see enough people acknowledging the fact that margins have disappointed. Oh, by the way, last week we got a jobs report, which wasn't that exciting, okay, which suggests that perhaps companies are cutting back now.
Doc, he's been dead right.
Yes, he has.
Why is he going to be wrong now?
Well, he might only be wrong about too far, too fast, but we're right into the range that he said that he was looking for.
Well, he thinks, his base case is right where you are, or
exactly.
A little low, actually, with today's move, a little lower than where we are now.
Yep.
Bull case is 3,000.
Mm-hmm. And
but he thinks the correction is going to continue.
So we got there pretty quickly because the sell-off was so extreme at the end of last year, and because Jay Powell made his pivot. I'm looking around not just at the FANGs. Of course, we all look at those, but I'm also looking at one of the names in particular within the FANGs, Netflix. It's up 35%. I have people pushing back at me all the time, Scott, about, it's too far, too fast in that one. Look at it versus Disney. Disney's down 73 cents today. Netflix is up $5. And by the way, Disney is struggling, and I think you're going to see AT&T struggle as they go to compete with these guys. Perhaps parent company of this network, Xfinity, Comcast Xfinity, going to struggle going up against these guys. People don't understand how much it takes to become one of those top stocks. Who's going to supplant Facebook? Who's going to supplant Amazon? Who's going to supplant Netflix? None of these competitors are really in the position to do that yet.
But that also ignores where Netflix was. So it depends on what your time frame is.
Okay.
So from the December lows, yes, it's come a long way, but it's still not at the old highs.
I agree.
So when Mike Wilson talks about Alphabet, I'm saying the stock's not back up to where it was.